In this video, we'll talk about how do you determine risk in one-way markets. Stay tuned. Hey traders, a very warm welcome to you. So a comment came in, thank you very much, appreciate all your comments and messages saying how do you, and this is a great question we get often, it's obviously something you think about as a trader yourself probably, I know I have, how do you get on board stuff that's just ripping one direction to the upside or downside? If it's a crypto, they've gone crazy in the initial part when they came out. Stocks, sometimes they just go completely ballistic in one direction. How do we get on board those while still keeping the risk managed? How do you determine the risk? And it's a great question to ask because too many people just pile in with no regard for the risk. So let's have a look at some strategies. Let's say we've got this market and it's ABC stock or it's whatever it may be, and it's just completely ripping to the upside. Maybe it's not even got these little pullbacks in it. Who knows? But what we need to do is look at the evidence we've got in front of us. So we're looking at it and maybe it's done something beforehand. Maybe it's a stock that's won a contract, or maybe it's the latest new thing, or whatever it may be, a crypto, something that is starting to kind of accelerate hard now. We want to get involved in it, but we want to determine the risk. Now, there are a couple of ways we can do it. The first one is that we can look at the size of the pullbacks on the move. So we look, and this example is obviously not very much, but we look at this one, this one, this one, this one, this one, and we see the largest pullback. So the largest pullback in size, and we use that as a benchmark for our risk. Now we either say, okay, that's the largest pullback, we're going to use that a little bit more, or we say to ourselves, okay, that's the largest pullback, I'm going to buy at half that. So if the largest pullback is, say, I'm just going to use a random number here, 100 pips or 100 points or 100 cents, whatever it may be. I use it in points here because we're not necessarily a currency. I'm going to buy at 50 points from the high, and I'm going to use a 100-point stop. Okay, now obviously that's going to allow you to be in on a little bit of a pullback, not waiting for the biggest one, but then it's going to put your stop 100 points below those. So the chances of you staying in the trade are good. If this continues the way it is, it's good. You're not literally chasing the high, but you're buying and you're using the data you've got from that move to quantify your risk. So quantifying your risk, determining your risk, is based on previous adverse moves away from your potential trade that you're about to take. Okay, so I probably should have left some of that on there. Let's put it back on there. So we've got to say, so largest pullback. All right, number two we've got is the range, or the average true range. I'm going to put average in brackets here, because what we want to see is, if we're just buying, we want to see the average range of the stock or whatever instrument it may be. I'm saying stock, but it could be a currency pair, it could be anything, as I said. But if we have the range and we know pretty much what the market generally does from low to high, then we can use that as a way of framing our risk. We can say, okay, if we're being extra aggressive, maybe we want to just use one. That might be a bit too aggressive because one down day we're out of it. But if we're playing the odds in our favor and saying, well, actually, we haven't had many down days, let's go in and use kind of the full day's range as my risk. Or a bit more conservative, you might say, okay, let's use 3 times the daily range as risk, and just giving yourself the noise. The point is that you're managing risk. You want to give yourself a stop that accommodates noise, and then you work back from that with your position sizing. We've done another video on that. You've got your actual stop in terms of points, and then you work your position size based on that. So that's one way of kind of doing it. When something is just going vertical, is saying, okay, there's my risk on that. And number 3, okay, the number of red days, and this is obviously going to be green days for a downtrend. What I mean by that, so you look at this information here and you say, well, actually, how many red days normally do we have before we push on? And these brutal trends, you're probably only going to get 3, max 2. That's pretty much how it is. You might get a couple of reds, and then a green. So look at that pattern and say, okay, well, I'm going to buy on the the second red close, and I'm going to use the distance from that high to low. Let's zoom in on this a bit, guys. Right, so we've got the push up here. We've got a 1 red, and assume that's a bar. Another red, assume that's a bar. We're going to buy on this level here, okay, and I'll stop is going to be the distance from the high to the low of that bar. And we're going to extrapolate that out obviously down here. So it's giving us room, it's getting us in on a little tiny pullback as well. It's not going to be that much a bigger pullback, but it's trying to get us on board these strong trends. And again, you know, we can, everyone can stand there and say, yeah, you know, buy a pullback, you want to wait for a nice unwinding. When these trends are strong, you don't get them. You get brutal moves. You want to be in, you want to be out, maybe you want to be out quickly, but you want to get on that momentum. You're looking for that little pause, something or other. But the main thing is we're looking to determine, how do we determine the risk? At least there, we can kind of, you know, extrapolate that move out below and give ourselves a chance of getting in. And that's a chance of saying, okay, there's our risk. It's very quantified. We've got that number there. We know where we are. We move that down. We divide our total risk value by in the number of points, pips, whatever sense, what that may be. And then we know what our risk is going to be on that trade. Right. One final thing, guys, is with stocks, just be careful of gap risk. And the same with anything, actually, you know, even in currencies overnight or even indices overnight, anything you can't trade, whenever that market is closed or that exchange is closed, there is gap risk. And even with cryptos, be careful of the counterparty risk. In other words, can I get out when I need to get out? So understanding that as well, we're talking about determining the risk, understanding that, hey, if you're going to be buying a stock that's been up and up and up and holding it over the weekend or overnight, you've got to be prepared for some news to kind of potentially hit that. So allowing for that as well, not glossing over that. I know we've gone into more technicals here, but I also want to mention the point of, you know, when the risk is out of our control, when we can't trade it, i.e. the market's closed, i.e. the exchange goes down, i.e. there's no counterparty to take our trade, or whatever it may be. So understanding that is part of the thing as well. And if that's too high and the risk is too high, then, you know, stay out of this. But from a technical perspective, these are some things to look at. The largest pullback, the range, your average daily range, and number 3, the number of red days. Again, we're just making a little bit of an estimate here. This is not defined, but it's a good way of getting in. I've used all of these to get on board stuff before, and if sometimes you feel like, oh, you know, this is it's a bit rough, it's a bit loose, but it works well because, as you know, when things are going, they're going. You've got to find the slightest little reason to get in. Would you go crazy and pile in really aggressively? Probably not. But if you're in, you can start to add. Maybe you add every time you get a couple of red days. Add every time you get a couple of red days. But expecting a deeper pullback in all those things that come in with trends. But to get on that excessive momentum, really aggressive momentum, it's a great way of doing it. All right, guys, thumbs up if you like this kind of stuff. Comments, as always, appreciated. See you in the next one. Take care. Bye-bye.